Okay, let's dive right in. Just recently, the tech world saw some pretty serious drama unfold. A major player, SK Hynix, experienced its stock plummet nearly 9% in just one day.
Wow.
Yeah, that wiped out a staggering 19.3 trillion Korean won from its market capitalization. I mean, the total value of the company's shares, basically. It was a traumatic swing, really caught a lot of attention.
Absolutely.
So today we're taking a deep dive into what caused this sudden drop, the underlying concerns, and importantly, the conflicting views on what comes next. For this crucial company and the whole high-stakes memory chip market, we've pulled insights from various market analyses, various reports, to really get to the heart of the matter for you.
Right. And today, we're really going to dig into the two very different ways experts are looking at SK Hynix's future. We'll focus specifically on that highly competitive high bandwidth memory, or HBM sector. We'll look at why some analysts are predicting, well, headwinds, and why others see a strong rebound.
Okay, so that's the headline drama, but what was the fuse? What actually lit the sudden downturn for SK Hynix back on July 17th?
Well, the immediate catalyst was a report that came out from Goldman Sachs. They downgraded their investment opinion on SK Hynix to neutral, which essentially means, they no longer recommend buying the stock. They see less upside potential now.
Okay.
And they cited intensifying competition in the HBM market and also concerns about potential price declines down the road.
And who was behind the selling pressure that day? Was it specific types of investors pushing it down?
It was primarily foreign investors, actually. They sold about 564.7 billion Korean won worth of shares. And institutional investors, the big pension funds, asset managers, they offloaded another 289.1 billion Korean won. And actually, those institutional investors had been selling for 5 consecutive trading days leading right up to this. So that totaled something like 767.2 billion Korean won just in that short period.
Wow, 5 days straight from the big institutions? Does that maybe signal a deeper underlying concern than just one report? Or is that just how the big money reacts sometimes?
Well, it can often be a bit of a domino effect, right? Once a major firm like Goldman Sachs shifts its stance so publicly, institutional investors especially, they'll reevaluate their positions pretty quickly. It's about managing risk for them. So yes, it often does reflect underlying concerns, even if some might see it as perhaps an overreaction to just one piece of research.
Okay, that immediate trigger makes sense. But the real kind of crux of Goldman Sachs' argument seems to lie in their longer-term outlook. What exactly are they forecasting for the HBM market that led to such a strong downgrade, especially, given the current boom in AI that needs this stuff?
Right, that's the interesting part. Goldman Sachs forecasts that starting next year, so in 2026, HBM prices are actually expected to decline for the first time. They believe that pricing power, the ability to set prices, will shift away from the suppliers like SK Hynix and more towards the customers. The buyers will have more leverage.
Ah,
Now, they do acknowledge robust demand for both HBM and general memory in the near term. They actually raised their 2025 earnings estimates for SK Hynix because of that. But their core concern is really for 2026. They predict HBM prices will drop by a double-digit percentage next year. And that, they figure, would cause SK Hynix's operating profit for 2026, that's the profit after operating expenses, to actually be lower than in 2025, despite the continued demand.
so even with strong demand now, they're looking out to 2026, predicting a double-digit price drop. But isn't the HBM market still, I mean, relatively new, and demand seems exceptionally high with AI? Is it really that clear-cut that pricing power will shift so quickly?
And that's exactly where the counter argument comes in. It's definitely not all doom and gloom across the board. There are many other brokerage firms who are, let's say, cautiously optimistic about a technical rebound after such a sharp fall. They believe it's really far too premature to conclude that HBM competition poses some kind of structural risk to SK Hynix.
Okay, so what's their reasoning then? Why do they feel this isn't a long-term structural issue?
Well, for example, Chae Min-suk, who's a researcher at Korea Investment and Securities, she points out a couple of key advantages for SK Hynix right now. First, their HBM sales already make up over 50% of their DRAM revenue, so it shows how deeply integrated it already is into their business.
Right, half their DRAM revenue.
Exactly. And second, she highlights the company's advantageous cost structure and, importantly, its high yield compared to competitors. That yield basically means the percentage of good, usable chips they get from each silicon wafer. That's absolutely critical for profitability in this business.
Makes sense. And what does this more optimistic view suggest for SK Hynix's actual performance in the coming months, beyond just its current market position?
Well, Korea Investment Securities, for instance, anticipates that SK Hynix will continue to set new quarterly maximum performance records right through 2025. They expect the upcoming Q2 earnings, which are set to be announced on July 24th, to likely exceed market expectations, and that, they think, could help the stock price recover.
Okay, so upcoming earnings could be a catalyst.
Precisely. And this optimism is also tied to the upcoming earnings season for the major AI players. You've got AMD coming up in late July, NVIDIA in late August, Broadcom also late August. Those announcements are expected to reconfirm just how strong AI demand is, which is obviously crucial for HBM. So Korean Investment Securities, they're holding firm on their analysis. They maintain a buy rating and a target price of 340,000 Korean won for SK Hynix.
It really feels like we're watching two different movies play out here. One's a cautionary tale about future competition, the other's almost a blockbuster about current overwhelming demand. So what does this all mean for you as you try to navigate this kind of information?
Yeah, it's a clear split, isn't it? We've seen one view reacting to potential future competition and potential price shifts down the line, while the other view really emphasizes the current strengths and the expected near-term performance. What this really boils down to, I think, is the market trying to price in future uncertainty versus current strong performance. It's a dynamic tension, and it highlights how even slight shifts or perceived shifts in that long-term outlook can trigger immediate sharp reactions, even when the near-term fundamentals still look pretty robust. It's sort of a classic tug of war, really, betting on potential future problems versus riding the wave of current success.
Exactly. So for anyone trying to make sense of these kinds of situations, maybe the key insight here isn't always about which prediction is definitively right, but more about understanding the drivers behind each viewpoint. Are they reacting to a genuinely new piece of data, or is it a new interpretation of data that's already out there? And this raises an important question, I think, for you listening. When you're faced with conflicting analyses from sources that seem equally credible, how do you determine which perspective might hold more weight? Or perhaps what combination of insights paints the most complete picture? It's a fascinating challenge, really, to consider how future predictions, especially in these fast-evolving tech sectors, can diverge so widely just based on different assumptions about what tomorrow might bring.